You say today you are more confident of greater than 4,800, but not ready to give up on 5,100. He says it's impossible, my words, not his, given what the Fed is going to do and where we are. What's the counter?
Well, I mean, I think the counter is if we end up with a growth scare, and today's jobs report is tracking towards that economic activity is softening up, but the underlying fundamentals are strong enough for us to not have a recession. Well, that along with the fact that inflation, I think it's cooling pretty rapidly. We can see it in all the leading indicators. So our inflation dashboards really show that over the next 6 to 12 months, inflation will cool. That puts the Fed in a position to stop shocking markets. They don't have to pivot. They don't have to cut rates. But we can just say, look, if the 10-year stays here at 2.7, even at 3, that's a 33 PE for a bond. The stock market can re-rate. So I think a lot of the reason stocks can surprise, which is what happened in 1982, is that the multiple reaches a new equilibrium because the Fed is no longer shocking. We're avoiding a recession. The 10-year is going to be how we calibrate PE. That PE of 20 is not expensive if the bond market is the 10 years somewhere between 33 and 37 times. You know, today, if you buy a 10-year bond at 2.7, you're paying almost 37 times for that coupon. So I think that's the reason why 4,800 comes into play. In fact, I think our technician, Mark Newton, thinks that there's greater than a 50% chance that you're well above 4,400. In fact, it's somewhere between 44 and 48 is where he thinks we end the year. And again, it's not because the Fed has to cut. It's just that we've got higher rates baked in. It's the shock to markets that's going to matter.
I know, but the P only works if the E earnings remain at minimum where they are now, if not higher than where they are now. You can't have earnings go down and have the P still work, can you?
Oh, that's right, Scott. I mean, even if you look at today's labor report, wages are still growing 5%. So we're not talking about wages growing at 0. And nominal GDP, came in the first half over 8%. So let's say it's, still 6, 7, 8%. That's still enough for companies, as long as they're not hit by bullwhip effect and inventory corrections, to generate double-digit earnings growth. So I would say part of our view is that the 2023 EPS numbers, which are maybe at 245 now, they don't have to come down to 200. They might go to 240, but that's 2.5% off the highs. It's not like E fell so much that you got to take the S&P down to the 3,000 level that so many are talking about.
Well, I mean, assuming they hold up at 240. So Rob Sechan, I mean, Tom Lee, says maybe you're not getting the whole story here, that inflation's coming down maybe faster than you're giving it credit for, that the economy can have this soft landing, and that he can be right. And, you don't have to be sitting back drinking a beer thinking everything's great. Maybe things are going to be just fine.
It's hard to go against the market master. He really knows how to read markets, but I boil it down to kind of simple fundamentals. Is a slowdown in the pace, is a change in the rate of change by the Fed enough to lend the support that is required for the multiples that we have in an environment where earnings are, likely to come down, right? And that's all it is. It's at what price we want to pay for this. And we're trading at 18.5 times. A lot of what's happened recently has been multiple expansion that has been driven by a market narrative that the Fed is going to pivot sometime in 23 and maybe even cut rates. I just don't see that. And so I'm not suggesting being bearish. What I'm suggesting is caution in the way that you're positioning, so you're not exposed in the event that narrative of slowing down being supportive doesn't play out. That's all.
Yeah.
Right, but Tom, you're not necessarily cautious.
The future's uncertain. So everything Rob's described is plausible. But if we think about second half of this year compared to the first half, I'd actually say that there's more reasons for earnings to accelerate, because the inventory correction, which took out 2 points out of GDP in the second quarter, and companies still generate double-digit earnings growth, That's gone. In fact, there might be some inventory building. That's a tailwind for cyclicals. Gasoline prices have fallen. That's less wallet dedicated to gasoline, more for consumer spending. That's accelerating. And then we are through some of the worst of these inflation year over year comps. That's less bullwhip and margin pressure, and wage pressures are easing. So that's potentially margin supportive in the second half. So I wouldn't necessarily say it's baked in the cake that earnings should be decelerating. Earnings could actually surprise in the second half as well.
Yeah, you say that buy the dip regime is back. How long can it stay that way, though? I mean, you're already, I almost feel like we're getting to a point where people look at this move that we've had and say, I need to like take some chips off the table here and sell some of this rip rather than buy any dip. What do you say to that?
It's a great question, Scott. If a buy the dip regime is actually in play again, it's going to last for many months, maybe even a year. What I can see from our clients, we had a team huddle yesterday. We can see our clients are selling this rip. They're raising cash, getting more defensive. We know that in aggregate positioning is still hyper cautious. CTA cash positioning or risk off is the lowest, 6th percentile. We know it in the prime brokerage data. We see it in talking to our clients. So nobody's really adding risk here at a time when everyone said a good jobs number should take the market down. We're barely down today. I just think it shows you a lot of things are already baked in. And if it's a growth scare that's coming to play, I just think that a growth scare means PE is going up a lot because the 10 years at 2.7.